Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by BuxtonCo.com. It's a Buxton. They have incredible service. It's mobile and predictive analytics, and we use this in our commercial real estate practice here at my shop at Bull Realty. It's incredible what you can do for due diligence and leasing and marketing of properties. Check them out at BuxtonCo.com. Well, we have a great show for you today. You know, one of the things we like to do is cover some of the major annual and semi-annual reports. And today we're going to cover the 2022 mid-year REIT performance report put out by Nareit. Obviously, REITs own a lot of commercial real estate, and their performance and outlook can kind of give us all an idea of what's going on out there. Please welcome my guest. This is John Worth. He's Executive VP of Research and Investor Outreach with Nareit. John, good to see you. Thank you for joining us, sir.
Thanks for having me on, Michael.
Well, thank you. And first of all, you know, we're all a little concerned about the economy here with what's been going on, right? With the Fed raising rates kind of so quickly at this point. What is going on in the economy? I know it's a big question, but, you know, related to commercial real estate and the economy, kind of what do you see moving ahead for us?
Yeah, thanks. And you know, we view right now as a period of real transition, both for the macroeconomy as well as for commercial real estate. We'll get into the commercial real estate later, I'm sure. But when we think about the macroeconomy, you know, we're obviously seeing increasing signs of slowing and much more pessimism. And we're seeing that pessimism in households. We're seeing that pessimism in investors, obviously, as reflected in the stock market. And really importantly, we're seeing that pessimism reflected in CEOs and capital allocators. I was recently at an event with a lot of real estate capital allocators. Question was asked, are we going to be in recession in the next 12 months? Raise your hand if you disagree. I was in the front row. I was the only person in a large room of capital allocators who raised their hand saying we weren't going to be in recession in 12 months. So I might be right, I might be wrong, but that tells you that the sentiment of those people who are allocating capital has really turned negative. Now, the reason why, I can tell you all the reasons why the downside case, I think we all know that, and we're today as we're sitting here, we're probably going to get a 75 basis point move from the Fed. This week, we're going to see Q2 GDP numbers. I don't think they're going to be great by any stretch of the imagination. We'll see whether they're negative or positive. I think that's a bit of a coin flip right now. What gives me a little bit of optimism, especially for the next 12 months, is really the strength of the labor market. You know, right now we have 1.7 job openings for every unemployed person. Last month's job report was actually surprisingly strong with over 300,000 jobs created. And importantly, we're starting to see labor force participation among prime age workers tick back up. And that's really critical to my slightly more optimistic than consensus view, which is that what can keep us on a growth path, and obviously we're going to see a slowing economy, but what could keep us in positive territory over the next 12 to 18 months is really households re-entering the labor force as they're feeling their budgets stretched by energy costs and inflation, re-entering the labor force, working more hours, maybe even increasing productivity, and keeping their spending going. So that's my what I call my slightly more optimistic than consensus case. But just right now, you know, basically, you know, we're seeing growth estimates being slashed for next year. We've seen the probability that we're in recession next year basically triple since January, with you know, consensus estimates nearing 40%. So I think it's not a great outlook, but it may not be as bad as the current consensus.
Yeah. Well, John, it's very cute that you think we're all going to get back to work finally, right? No, it's been the Great Recession, right? I'm not the Great Recession, the Great Resignation. No one wants to work anymore.
It's been really tough. You know, I think ultimately we may end up calling this the Great Reshuffling, in the sense that I think a lot of people, you know, had the opportunity either because of stimulus payments or unemployment payments to really take a step back from jobs that, frankly, they really disliked. I think that, Michael, I know you like your job. I really like mine. It's hard to put yourself sometimes, I think, in the mindset of somebody who really works a lot of hours at a job that is not intellectually stimulating for them, and that they really find unpleasant. And a lot of people in that position took this as an opportunity to move up, get higher hourly wages, or find something that they felt like was a better fit for their skills and their lifestyle, and that's creating a lot of disruption throughout labor markets.
Yeah. Well, it'll be interesting to see when this labor market kind of turns around a little bit, and some of the leadership and some of these companies can get folks back in the office for the benefits, for those people and their careers and the economy overall. Well, so there's increased pessimism about the economy and potential recession. What kind of landing could we have here? How is it with that? If we do hit a recession here, by its definition, how might it compare to what I just recently called the Great Recession? I don't know why it was called great. I didn't think it was that great, but
Yeah, I don't think we're going to see anything as sharp or as steep as what we had during the financial crisis, and certainly not something as sharp as the quick contraction we had during sort of the COVID period. And I think it's important to keep in mind, and the reason is because I think that we're going to see, banks are healthy, credit markets and credit conditions will stay open. We'll have active lending markets. We're not going to see that kind of credit crisis driven contraction like we had in the financial crisis. And I think, we have to, I know memories are short, but it's really important to keep in mind that what the Treasury and the Fed did across administrations to allow us to have a sharp recovery from COVID really needs to be applauded, right? They moved quickly to make sure that financial markets stayed open, that there was liquidity in the system, and that really kept us from having our COVID shutdown related economic crisis, sharp slowdown in real activity, turn into something like the financial crisis, where we had a sharp credit contraction. And so in some ways we're living with what your guest last week, Marley, talked about, the aftershocks of the earthquake of COVID, and I think some of what we're living through right now is aftershocks. But I think it's important to keep in mind that what we got from some of those policy efforts really helped us avoid what could have been a really terrible economic contraction that could be still ongoing if we hadn't seen policymakers act quickly.
Yeah. And John, there's some other aspects, right, that are a little different than previous recession, if you will. The amount of debt, right, on properties, and we have less debt on these properties, on commercial real estate.
Yeah, for sure. We've generally seen deleveraging. We've got lower interest expenses going in. We've seen generally tighter underwriting over the last cycles. It may be that we were seeing things get a little loose as we sort of came into the end of 2019. Certainly, all those underwriting standards have tightened up, but in general, we're not going in either on the household side or on the commercial side with nearly the type of leverage and risk taking that we had going into the financial crisis. And that's sort of one place where we certainly see that in the piece of the market we look at most closely is in REITs, who have been really deleveraging almost continuously since the financial crisis, and came into the COVID period with historically low levels of leverage, a great amount of access to liquidity, both on their balance sheet and in terms of lines of credit that they were able to draw down in some of the harder hit sectors. Today, very low interest expense and very well, the tenor of the debt is quite long. So they've got an average term to maturity over 7 years right now. So that gives you a lot of confidence, both going into an economic slowdown and going into a period of higher rates. And I think, I don't think every piece of the commercial real estate market is as well positioned, but we're certainly not looking at the amount of leverage and the type of structure of that debt we had going into the financial crisis.
Yeah. And John, when you look at the impact of a potential recession on commercial real estate and REITs, and you compare it to past cycles that we've been through, how do you feel about the amount of supply, the new construction? It seems like in past recessions we were obviously overbuilt. What do you see today?
Yeah, this has been a really interesting cycle in the sense that we just generally have not seen systematic overbuilding. So that doesn't mean that we haven't seen markets that got overbuilt in a particular segment, but those have tended to even out relatively quickly. And I think actually, in some ways, this may be part of the new normal of commercial real estate. I think when you think about today, the amount of market intelligence you as an investor or developer have about what's under permit, what's in planning stages, what the demand looks like in a particular part of a city or in a particular region, you're so much better informed today. And I think that has worked to ameliorate some of the boom aspects of building booms, as you're much better informed about what other developers are doing and what else is in the pipeline. And there's a lot more flexibility about moving to other markets. So I think that we're going in from a supply perspective, really in quite good shape. In the areas where we've seen really meaningful amounts of supply coming online are areas where I think we'll see demand hold up quite well, and that includes industrial and logistics and multifamily, where even with a recession, I think we're still going to see millennials creating their own households, and when you go into and I think we're going to have a mild recession if we have a recession, when you go in with 5 to 7 million housing structures short, that gives you quite a bit of cushion to make it through a slowdown.
We're talking with John Worth with Nareit about their mid-year report, and John, one of the things that really makes commercial real estate and real estate in general, I think, attractive to investors is, over time, inflation can be a benefit to commercial real estate. So what do you feel about the impact of inflation that we're having now and that we expect, and the commercial real estate world and REITs?
Yeah, we've certainly looked at the performance of REITs during inflationary periods going back through time. And of course, we have to go back quite some time to see levels of inflation like what we're experiencing today. But what we see is that REITs systematically outperform the broader stock market during periods of high and moderate inflation. And I think that's no surprise to commercial real estate investors. They are able to pass through some of their cost increases in terms of rent. And then, of course, as we see replacement costs rising, and that's been a dramatic shift in this market, construction costs have risen much faster than the overall rate of inflation. They see the value of their assets increasing. So we think that relative to other asset classes, there's no reason why this inflationary cycle should be any different from prior cycles. And in those prior cycles, REITs, commercial real estate, have systematically outperformed. So we think commercial real estate needs to be part of every investor's portfolio. We think REITs are a great way to get access to commercial real estate. It pairs very nicely with other forms of ownership of commercial real estate. And an inflationary period is one of those times when I think a broad base of investors sort of see why it's so beneficial, how that diversification benefit and how that inflation protection can benefit them over the long term by being in their portfolio.
Yeah, I mean, I may be accused of singing to myself in the shower here, but of all my investments, I really like in commercial real estate in these inflationary times, and actually acquiring some more, especially when these cycles are illustrate that might be a good time to buy. And that kind of leads us well into my next question for you, and that's performance on these properties. What do you see for performance of the commercial real estate that's owned by REITs?
We've seen this real split in terms of the year so far. We're just entering into Q2 earnings season, so we're getting a lot more information and intel. But what we saw coming out of the first quarter earnings, and we gathered the REIT industry together in early June, and we got to hear from the leadership of most of the REITs then. And what we consistently heard was that operational performance has been really quite excellent. In early June, we heard, systematically that it was green across their dashboards. Rent growth was up, occupancy was up, very strong demand. So they certainly at that time knew that there were forecasts for a slowing economy. They're preparing for it. They're starting to put it into their forecasts, but in terms of current operations, they're really not seeing it. And as we're early in the earnings cycle for Q2, but that's certainly consistent with what we're seeing coming through in terms of a very strong second quarter, very continued strong demand, a little more cautiousness about what's going to happen for the next 12 months, but that's really being driven more by external forecasts than what they're seeing in their own portfolios. So that stands in stark contrast to what we've seen in the stock market this year and the stock market performance of REITs. REITs as of yesterday were down about 16%, so they're outperforming the broader stock market by about a percentage point as of yesterday. But there's a real divide between the stock market returns, where I think they've been drawn down with the rest of the stock market, and their operational performance, which continues to be quite strong.
And we can't have a discussion about the economic environment in commercial real estate without asking about the impact of rising rates. You talked about it earlier. The Fed's were expecting a 75 basis points increase, and it's been really remarkable to be so low for so long and then move things up so quickly. What do you think about the impact there?
The first impact we're seeing, and we've certainly been hearing this, and I expect to see this in a lot of Q2 earnings reports, has been just the slowdown in the number of transactions. I think, as one of our CEOs put it, buyers want tomorrow's price and sellers want yesterday's price, and we're sort of having trouble finding that equilibrium point. And I'm sure you're seeing this with your own properties and the properties that you're marketing, is that when you don't have stability in terms of what cap rates you should be targeting, what you should be expecting, and what that cap rate spread to treasuries should be, or is generally, it makes it really hard to get deals done. So I think the first thing we're seeing is just this slowdown in transactions. In the REIT space, we've also seen, interestingly, and probably not surprisingly, we've seen a real slowdown in capital market activity. So REITs trading at a discount this year have not been issuing much equity, and they've also have not been issuing a tremendous amount of debt. So we actually view this as actually a sign of strength, because what that is showing you is that REITs are not being required to go to the financial markets to refinance debt right now. And so they've been able to be a little bit selective, sort of go to do refinancing at a time and place of their choosing in a way. So they've essentially been staying out of the capital markets. And I think that's linked to, both not a slowdown in acquisitions, slowdown in dispositions, and essentially the financial flexibility that their balance sheets afford them right now. So they don't have a tremendous amount of debt coming due this year and next year. So they've been able to have a little bit of a wait and see attitude towards capital raising.
Yeah. And if you're listening or watching the show, we'll put a link to the actual report on the show website at creshow.com, and you can also find it at REIT.com. And John, as you write this report and you're involved and you're talking about it, what does it leave you with at this point? Here we are, mid-year 2022, kind of looking forward. What's an overview that a takeaway for the audience?
Yeah, for me, it's really just this transitory moment, right? So for commercial real estate, for the macro economy, for REITs, we're really transitioning between, sort of the end of the end of the end of the end of the COVID era, right? Which really took us it was kind of a long roller coaster, especially when you looked at performance across sectors between, the sharp declines in early 2020, the recovery starting in mid 2020, and then that sort of the boost that a number of property sectors got as the population was increasingly inoculated against COVID and started to move back to normalcy in terms of how they were living their lives. And now we're really transitioning into a very new phase of slower growth. Essentially, most property sectors in the REIT space are essentially fully recovered from COVID, if not more than fully recovered. We had earnings in Q1 that were the highest ever, and most sectors had earnings that were above, and in some cases well above their pre-COVID quarterly earnings. And now we're transitioning into what is probably going to be a period with, I think, higher rates than we had prior to COVID. I don't think they'll be. I don't think we're going to be seeing the 10-year Treasury running at 5% and 6% for any meaningful period of time. But I do think we're going to have systematically higher rates for a time, and a period of slower growth as we essentially recalibrate to the post-COVID and post-COVID stimulus world. And that's going to take I imagine that's going to take 12 to 18 months, and during that period, I think we're going to see, like I said, I think we're going to see transactions slow down a bit, and we'll see capital markets activity be dampened a bit. But typically, when you come out of periods of disruption, REITs have tended to find a lot of opportunities in those periods because they have access to both debt and equity markets. They tend to have some advantage in terms of raising capital in those periods, and tend to see fairly strong growth coming out of periods of disruption.
And John, what would you say to folks who are really concerned about these interest rates? This will show my age. No, not my age, my experience level. I remember when I got a 12% interest rate on a property, I was really excited and sold properties during periods of really high rates. And the market worked. People made money. Companies made money. What would you tell folks who figure like these rates today are just so high? How are we going to exist?
Yeah, I mean, I think the market always finds an equilibrium. And I certainly, even in my own neighborhood, my neighbor across the street, his first mortgage was at 13%, and I've got some, 30 young people in their young 30s on the other side of me across the street, and they can't imagine having a mortgage, at 4%, right? But you make it work in the household budget in the residential side, and on the commercial side, those cap rates are going to adjust, but it is going to take a time for people to really get their head around some of these rates and how deals pencil out at the higher rates. But I don't think we're going to be headed to these 12s and 13s. I think we're more likely going to be in the 4s and 5s. But it is a different threshold for deals. So 4s and 5s versus 3s is going to mean some deals don't pencil out. but the deals that have a lot of quality economics behind them are still gonna work.
Yeah, it's interesting. I've got a lot of clients over during my career where when I called them about buying properties that I had listed during really good times, they were like, "Michael, it's so cute you called, but you know that I'm not going to buy until we're in a down market." You know?
Right.
And so and I think it's some investors look at it as potential opportunity, especially in some of the sectors that are maybe more impacted by COVID and work from home, like office. In my mind, it could be like right after the Great Recession when home values dropped and then they went up. You know, if office is kind of down, people think that it's a bad market for office. Maybe some of these REITs and other investors getting some good office deals.
Yeah, I mean the office market has certainly been the one with the most outstanding questions. And in fact, in the REIT space, when we look at performance across the COVID period, really starting February 2020 through today, office is the worst performing sector, and that's not because of operational performance, right? Rents were paid early, sort of. The we still they've still got tenants in these they've got rent paying tenants in these properties. Leasing is happening, but it's just this, I think, fog of uncertainty that covers the office market and what's going to happen both in terms of a quality divide in terms of office, central business district versus suburban, and just the impact of work from home. I'm personally I think that it's gonna take time for this to sort out, but I do think that as a society and as organizations, we are going to come to the conclusion that it's really important for people to be together physically as colleagues, to work together. That doesn't have to be 5 days a week, but it certainly can't be 0 days a week, because what you see in any organization is as you go through time where you're not interacting physically, where you're not really getting to know each other as colleagues and teammates, you start seeing those fissures open up, and those ultimately result in lower productivity. And I think we'll see the organizations that are trying to be fully remote. I think it'll be an interesting experiment, but my money is on the organizations that are continuing to bring people together on a regular basis.
I'm with you, and these Zoom meetings and trying to communicate by email, it's so inefficient that it sometimes is frustrating. So I agree with you, but it seems like the demand might not pick up for office space until, as you mentioned earlier in this show, this employment market changes, right? And people actually get back to work. We're all lazy now.
Yeah, well, I think for most of the office market, it's they're working, they're just not working in the office that much. We're seeing nationally, we're seeing sort of swipes into the office running 40-45%. I would have guessed we would have been higher than that by now. I think that we're going to find this new level, but I do think it's going to take some time because I think in every organization it's a real challenge between you want to offer flexibility, but you want to bring people together. And in fact, one of the things that I find is that our team, my team, they want to be together. They want flexibility, but when they come into the office, they want their colleagues to be there. Because that's what adds value. There's nothing I think as disheartening as going through your commute to show up in the office and find you're the only one there. And you say, "Well, I could have been sitting on my porch at home doing this,
Yeah.
right?" So and this is where organizations I think are increasingly gonna find the path to provide flexibility, but also to really just highlight that importance of we need you as a team to get together physically. But also, I think for employees, it's really important for their emotional well-being, for their career development. It's important to be around your colleagues, to develop those relationships, to find mentors, to find friends, to build those relationships, and frankly, to to get out of your house and engage with the world around you, right? I mean, that's, if you just spend all your time in your house, you're going to go crazy after a while.
John, you're actually talking about having a conversation with someone and not just texting and emailing and stuff like that. That's crazy, John.
Yeah, every once in a while you got to go sit in your colleague's office and close the door and have a real conversation with them about who they are and what they want to achieve in their life. And you don't do that by Zoom.
That's it. Right? All right. So I have a challenge for you, John. Our next show, you have to leave DC and not do Zoom and come to Studio One here in Atlanta. Okay.
Absolutely, 100%. I'm back traveling. I'm talking to investors in person, and I'm so happy about it. It's tremendous. I'm happy to go anywhere these days.
Great. Well, thanks for doing that, and thanks for being on the show. Great information, John. We appreciate it.
Happy to do it, and look forward to the next time.
All right. Thank you. And thank you for listening, watching the show around the country. We appreciate you doing that. Please subscribe and hit the notification bell or whatever would let you know that a new show is out there that may be valuable to you or your connections. Again, thank you for watching. And please contact me if you have any questions about the show or commercial real estate. My email is michael@bullrealty.com. Until next week, be sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Buxton. Take leasing, site selection, and due diligence to the next level. Make the right decisions with on-demand mobile data. Visit buxtonco.com. By Bull Realty. For proven commercial real estate asset and occupancy solutions, contact me. My email is michael@bullrealty.com. By Commercial Agent Success. Expert level commercial real estate broker training. Cloud Access 1 up to 21 one-hour videos. Visit commercialagentsuccess.com. Thank you for reviewing, subscribing, and sharing America's Commercial Real Estate Show.